Hey. So for this episode, what we did was we grabbed a couple of different articles from Yahoo Finance and Wall Street Journal. And they all are addressing this topic of what does retirement look like now? What are recent changes in the job force doing for retirement savings? And if you are in retirement, what are some of the issues and challenges that you're facing right now? So there's a lot that we could talk about today, a lot of material, but let's go ahead and dive in. So if we're just talking about if you're a person in retirement today, what are some of the fears, the concerns? What's the climate that you're dealing with right now?
Well, I think the biggest fear that people have is they're going to outlive their money. I mean, that's got to be the biggest fear. They're going to have an unusual expense that they're not going to be able to cover, and it's going to deplete their resources, and they're going to have to change and alter their lifestyle. I think that's a big fear.
Yeah, and I think because of that, we see a lot of people slow to say, hey, I'm going to do that traveling. We just retired. We wanted to drive up to Seattle. We're not going to do that because what if we run out of money? Or they don't make the choices in the early years of retirement because they're concerned about 80-year-old them, 90-year-old them, which is reasonable, right?
I think this is born directly out of the increase in healthcare delivery costs that we're seeing in long-term care expenses. So they've watched others go before them that have had to spend an extraordinary amount on those things. And ultimately, they don't want to run out of money and they don't want to be a financial burden on their family members.
Yeah, and the same point in time, it's a fear of, am I going to be able to get the health insurance coverage or what I need? I just read an article today about cancer patients, and living in an urban setting is so much better than living in a rural setting because you have access to all the new breakthroughs and introduction of new treatments when you're in an urban setting and you're, so to speak, next to a hot spot, like Mayo Clinic or City of Hope or Anderson out of Texas. And there's a lot of hotspots where cancer is preeminent and they're dealing with it. But if you're in a small community in the Midwest someplace, it's not as prevalent, that information, and treatments are not going to be as ready available to you.
Right, so, not as accessible. So
right.
Maybe you even have transportation costs, or you have to move
For sure.
out of your home, et cetera, et cetera. I mean, and we talked about the rising cost of healthcare delivery, but I think overall retirees are also just dealing with inflation right now.
Yep. And that's a weekly reminder, right? You go to the store and you buy eggs and you go, oh man, that was more. And then if you remember, we had eggs that were extremely expensive. They came down, and then last few weeks they came back up, that specific item. And that's one that it just feels, even if general inflation is cooling, even if the economy is doing well, you still feel it every week at the grocery store.
Yeah, and I think most consumers are seeing that inflation is kind of embedded right now. It's not as like you're going back to the eggs. It's not as though eggs are dropping $1 per dozen. It's just that's kind of embedded in there, and so they're having to go, wait a minute, am I going to have to pay this higher price forever? Yep. And you look at that with your wages. Are wages increasing substantially greater than the cost of consumption? And I think most people are realizing, this is a deal. This is a long-term deal.
Right.
So you teed that up perfectly, because I hear more frequently from our clients who are either in retirement or approaching retirement that they are considering some sort of semi-retirement option. Mm-hmm. So it could be leaving their current employer, but doing something that, quote unquote, they've always wanted to do. It might be more so for emotional, acute, extras, keeping their mental capacity high, just doing something that's interesting to them. It could also very well be from a financial perspective, just to bring in, so they're getting paid that current wage in this inflationary time, I guess.
Yeah. Well, staying active, and someone bringing in, I don't know, $30,000, $40,000 with a job that's not taxing them as their career maybe did, that responsibility, they feel that they can still contribute to their household and keep up with things. Yeah, I've seen a lot of clients who it's partly the money, but it's mostly, I think, just the activity to say, I want to be out. I want to be talking with people. I'm not ready to be done. I'm ready to be done with this career, but I still want to be working in a certain way.
And I think retirement is I want to say it's like one-off or something. But I mean, you work all these years, and then all of a sudden retirement is this transition into this different daily activity. And again, I'm older than both of you, but I don't see retirement as a blessing. I see financial security as a blessing, but I see retirement as a real detriment for a lot of people because their activity, their value gets placed in a different rung down, and I don't see that as a good sign. I see that as a negative sign, and I think people to get depressed, they're dealing with that, and I think the value of somebody's work and what they've done over the lifetime, that should continue on. Now, it may not be in the same job or the same circumstance, but I think the value, the wisdom, the knowledge that you have should be continued on in some degree. I mean,
Yeah.
you've been in appointments with me where I've talked to clients saying, no, this is not a good thing for you to retire.
Yep.
You know,
Yeah,
It could be that it's a good time for them to leave the high stress nature
Right.
of their job or an employer that they have felt strapped to for however many years, and they did the good work, they provided for their family, and now they're in a different season of life where they don't have to be tied to the same employer. But I agree with what you're saying, and I think what you're talking about in terms of, value being assessed is kind of a societal perspective, or
Correct.
like society as a whole, right? When you step out of the workforce, there becomes this question like, what value are you adding? How are you contributing? And I also think that broad stereotype society doesn't value legacy and wisdom earned by working for many years. So
in ways that should. We have a client, just as an example, we had a client who she was a teacher and worked in a school system and was ready to retire. So she did. But now she went and got another job. She is a water aerobics instructor and she loves it. Like she gets out and she gets people moving. She gets them, it's more of a senior class that she runs, but she loves it. And I think it's an element where she's still working. She still has, appointments to get to, a schedule to keep. But her stress levels are entirely different and she loves what she does. It's a good example of someone finding continued purpose and meaning and activity that's decoupled a little bit from their job. The other thing I think as we look a little bit too, that I see people on a regular basis as they're looking to retire is organizing, is that they feel like, inflation's high, this is high, and they look at what they have as far as assets. And it just feels like this jumble of stuff. Like I had that old 401k. I know there's an account there, but it's not doing anything. And they feel that what they have maybe won't be enough for what they need. And there's a big piece, which is really just getting organized. It's coming in, organize what they have. Often people will have old retirement accounts that we can combine and get them working. So instead of seeing, oh, I got this here, that there, they say, oh no, that's my main account and it has enough to fund my future. So I think there's that too. There's a little bit of uncertainty about the future, not just in what I'm going to spend, but also what do I really have and how long will it last?
It's interesting that you say organizing, because another one of the points here that I think is really interesting to draw attention to is, in retirement, it might be a season to literally lighten some of your personal property. Like you've gained, so, how many of our garages are busting at the seams, right? We've got that collection that we've had for so many years. It's not a bad time to start taking a look at some of that personal property that maybe you don't need. What's on the horizon where now if it brings meaning and value and enjoyment to you, by all means, hang on to it. But in an inflationary time period, it's not a bad idea to see if you have some personal property that might be better value to you in terms of some extra cash in your pocket.
Yeah, I think you should almost go through an exercise of not necessarily doing it, but think about if you had to move, what would happen? And you'd have to go through every room and you'd have to pack up all the stuff that's in each room, be ready to be transported to your new residence. How much would you keep? How much would you really keep? And I think everybody should. I mean, I don't think most people would do that, but I think it's a good exercise to kind of go into each room and say, okay, have I used this? Have I enjoyed this? Is it something that I would keep? But you're right, Laura. I think excess. We all have so much more in our household, and it just takes up space.
Right.
And it could be used by somebody else, right?
Right. This is inspiring. I've been trying to talk to my 10-year-old about how many squishmallows are a reasonable quantity of squishmallows. She's going to have a hard time in retirement.
Yes, right. With all the squishmallows. That's right.
But the other thing too, Dad, that I hear you say a lot in appointments for people that are kind of looking over the edge of retirement and they might be nervous. They might feel uncertain about that irregular income stream coming into their checking account on a monthly basis. And you say on a regular basis, you will adjust your life.
You will.
And we encourage people pre-retirement to take a look at their expenses and estimate maybe some changes in those expenses because we want to look at their capital needs over the long term. But it seems to be kind of hard to know. They assume that they're going to have a similar sort of lifestyle. And for the most part, maybe they will. But you've said that several times where, essentially you kind of adjust to what income you see coming in.
Well, again, it's discretionary expenses versus mandatory expenses. Like you're going to have to pay your insurance, your property taxes, those kinds of things. But there's a lot of discretionary expenses that people have, and it builds into their cash flow. Let's
Right.
take a look at each one of those. It's not to say that we'd eliminate them, but I think that it's important for everybody to kind of take a good hard look at how they spend their money, and is it something that they would continue. Now, the abrupt change is when a spouse passes away. Now, again, that's harder, obviously, but I would rather do that exercise prior to that so that people can take a look at what they're spending their money on, and is it something that they would continue to spend on if they had a choice.
Mm-hmm. Mm-hmm.
That's right. That's so good. And I think we find that people eat at the restaurants they want to eat at, right? They go to the places they want to go to. So a lot of that doesn't change in a major way. But to your comment, Randy, like we've had some clients that feel more liberal now. Hey, I've retired. I know we have enough money. We can do some of these things we never had time for. On the other side, we have clients who I'm not sure. So we're going to eat out twice a week or once a week because we're just not sure if we can keep doing what we used to do when we were working.
Right.
So,
And isn't that the definition of financial independence, right? You feel free to use your assets according to your desires because you're confident in the overarching plan. There might be some things like you're not driving to work, and so your cost of fuel goes down. Some unexpected surprises when you transition into retirement. But let's switch this to someone who is currently employed. And when we talk about retirement savings, what are some of the changes in the 21st century in the employer and employee retirement savings plan? Like, what are some of the changes that we've seen?
Well, 50 years ago, they went pretty much away from fixed pensions. Most private employers moved away from that and created and bought into the 401k, which means that the employee had to participate at a certain percentage. And it was kind of the introduction of that. Now, there are still companies and public entities that provide pensions, but the vast majority, in fact, only about 11% of the companies, privately held companies, still have pensions. The vast majority of companies have abandoned pension status, and that means that the employee has become the, so to speak, self-sufficient. They've got to make sure what they're contributing and what they're managing on that. And we see that all the time, that people just lose track. It's not something they wake up every day and do, right?
And this is where ignorance is not bliss, folks.
No.
This is not good.
Well, this is the turbocharge moment. We tell a lot of clients like, hey, you're the hero of the story. It's your life. It's your money. You've worked hard for this. We're just here to make sure that your cape is on right and you can be the superhero of your life. And this is a key aspect of what is your 401k doing. Man, we have so many clients that come in when they first start working with us that they don't know, like, wow, I've had 2 or 3 job changes. And so I think I have some money out there. I don't know what it's doing. When we get into the details, we've had some clients that they're just too aggressive, right? They started this when they were 20. They picked something that was very aggressive and they said, let it go. They've probably been rewarded over time for that. But as they're getting mid to late career, man, they're just too aggressive. We've had others who didn't know what to do. So they just put it in like some bond fund when they were 20. And it's just been a snail, their whole career. And it's so unfortunate because this, in my mind, this is a great area for a tune-up. The other part of these articles that we read, one of them I thought was a great comment, is that there's a psychology of having small accounts. Right. People, when they have small accounts, 10,000 here, 5,000 there, 20,000 here, that they're more inclined to cash them out. They're more inclined to not pay attention to the investments. Whereas if they took all those small accounts, rolled them together, either into a 401k at their current job or just into a rollover IRA, combine them all, that they then see that psychologically as, oh, this matters all of a sudden. I'm going to invest it. I'm going to let it grow. I'm going to keep an eye on it. Man, I think that's some of the value that we add is that moment of saying, let's consolidate all these little pieces. Let's get them working for you in a way that really makes sense for your future.
Right.
And people don't see the significance of accumulation. I mean, you got all these small accounts, but the average employment now is much more frequent. In other words, that you quit your job and work with another company. Over a period of employment, let's say 35 to 40 years, people change on the average about 11 times. And so what happens, particularly in the earlier stages, they leave retirement plans behind. Maybe they put money into a 401k. They started minimally putting some money in, but then they went to another job and they kind of forget about it. All of a sudden, this money's over here and they kind of forget about it. So there's no strategic plan to not only accumulate, but also to measure how much you should be putting in. And most employers match contributions. And so we've always encouraged our clients, make sure you contribute up to whatever the employer is contributing to, the match. So you're getting that full benefit. But I think I'm astounded at how many people don't have a clue how much they're contributing, and they pay no attention.
Or have forgotten about previous accounts. Like
Yeah.
I was laughing in the office yesterday. We have a new client coming on board and a lot of different accounts all over the place. And a lot of our job at the very beginning is like Sherlock Holmes, you know?
Yep.
And just kind of trying to piece things together between the two spouses. In this case, there was a predeceased spouse and a new spouse. And so what benefit flows to the children and what, right? Like, it can get really confusing. I don't fault anyone maybe for not paying attention to that stuff because it's a lot. Or just old account statements, old employers. You know, you move on. I think you said people change jobs now, average 11 times. I read like 11 to 13 times before retirement. So, you know, it makes sense that once you move on to the new employer, you're ready to jump into that new plan according to whatever the default criteria is. And now it is more often than not that the employer has a default savings contribution. So you as the employee would have to opt out.
And that typically is around 4 to 6%. I said,
Right,
read articles that 6% is the start.
Yeah, the rate is much lower, and especially if you were with a previous employer that was ratcheting up that savings contribution. So here's the slippery slope. You know, you might be at a 10% contribution from an employer, you change jobs, they drop you back down to the 6%. And there was this really interesting graph in this article that basically said the difference between working with one employer and a gradual step up in your savings contribution for retirement and hopping from different employers, right? And you can imagine kind of the zigzag, the up and down, and it impacts the accumulation.
Right.
And the accumulation is significant. We're talking about $800,000 over a 40-year period if you had an accelerated contribution amount. Now, most people think, wow, that's an amazing amount of money. But if you save slowly and consistently and you continue to accelerate your savings and you're always getting a maximum, because you're getting to the point where you're getting maximum contribution levels, people don't realize how significant that is in accumulation of money.
And it doesn't hurt in the moment when you do it piece by piece.
Well, one key thing I think about having an advisor is we talk about this, right? If you come in and you're mid-career and we get you organized, we get you on the right track, these aren't the things that you're going to forget about because we're going to bring them up at the next meeting. Say, hey, you were putting in that 5% into your 401k. Wonderful. Hey, I see you just got a raise. Do you think we could bump it to 7? Because that's really where we want you to be at this higher level. And I think the key thing is you said job changes, but the other is also just raises and shifts. There's so many folks who in their 20s who say, well, I know I need to do this. So I'll put in that 4%. I'll get that match. Perfect. And when I start making more, then I'll do higher. I'll do that. And then life goes on, they get a raise and that raise goes to something else. It goes to the buy a house fund or it goes to the baby fund or not that
buy
those are
a new
bad.
Car or immediate needs.
Yeah. And none of those are bad options. It's just making sure, if you start off, say at 4% and as your pay ratchets, well, let's make sure we ratchet that percentage up as well. So by the time you get to a retirement, not only are you making more, which would be great, but also you're increasing those saving rates. So that standard of living that you have at retirement is one that you could just continue, past retirement.
Now, there might be seasons where it makes sense to reduce or stop contributing to your retirement plan. And those are the anomaly, but there are situations where that might make sense. We have clients who are overfunded in their retirement. So all they're doing is shifting that tax burden from now into the future, but it becomes so extraordinary, it doesn't make sense from a strategic perspective. But here's where meeting with someone like us, we love doing this planning, you need some advice and you need some insight into how that sort of decision in the immediate is going to have the impact in your retirement planning.
Yeah, I mean, I think obviously it's rare to find a client that's over contributed to their retirement plan. But once they reach a level in the tax deductible plans, the normal 401ks, then you would move to a Roth. So if they've got enough money in those plans that's going to supplement their retirement with Social Security and other income that they receive, then we go to a Roth and we start using Roth as a contributor. I personally don't like to just start out with Roth. I think you take advantage early on as much as you can of the tax savings, but you can't track it. So once your accumulated value reaches the point where we're saying, I have enough money in that, then we shift to the Roth. Because then at that stage, most people would flip it. I've had a lot of conversation with different planners say, well, you'd want to use the Roth first because you're getting the longer term. I said, I want to take advantage of the savings. I want to reduce the contribution, the impact of the contribution, take advantage of that tax savings so people have more spendable when they're younger, because that's typically what people are concerned about, right?
Yep.
Yeah, well, yeah, when they feel they need it, right? And there's so many ways to split this, but Roth I think is so useful in that we've talked in the early episodes. It was in the 80s when they came out with these ideas of Roth accounts. So most people that we see retirement age, in their 60s and 70s, they have some in Roth, but not that much.
Right.
Whereas there's a generation behind them, the Gen Xers and younger, that they had access and thoughts about a Roth for most of their career. And so they have larger amounts in these Roth accounts. And for anyone who's still working, man, you have this strategic choice to say how much into a Roth, how much into a traditional retirement account. And there's no one size fits all. I mean, I have a few clients who they have really strong pensions. They have military backgrounds. And so the more that goes into a Roth is so useful for them because they never have a drop off in their income. But everyone's different, right? And I think it's such a useful tool. But I see that it's because it only came out in the 80s, they're not as well experienced, I guess, as many people as what they could be.
One of the best solutions I read in one of these articles was this idea of creating a lifetime account. So a retirement account that would transition with you as you transition employers. The statistic was if you have had multiple job changes, you will have a reduction in your overall retirement savings of $300,000 compared to the person that stayed with just a few or one employer for the duration. So
yeah. And part of that is having a separate account. Part of that is just tracking, right? And making sure you're keeping up with it. And to tell someone, hey, if you keep track of these little 401ks and IRAs and you roll them together, man, this might be a $300,000 benefit just by paying attention.
Right.
That's phenomenal.
Right. You might get the whole cookie and not just the crumbs.
Yeah.
And that's the advantage of bringing in a fee-based, a fee-only advisor early on in your career, so that somebody can assess where you're at and what you're doing, and also point out those things that you could do better.
Right.
And do it in a relationship where we're really looking at what's best for you. And I think that's really important. I mean, the earlier that gets established, the better the results will be, because, I'm sitting here at where I'm at, and I'm telling you, 20, 30 years goes by with a blink. And you look back and going, well, if I would have done it this way versus that, and you don't realize how much impact that long-term savings or that long-term consistency provides to a much better outcome at the end of your life.
Yep.
Retirement.
Yep. Well, with that little bit of wisdom, I think I'm going to wrap this up for today. I hope this was helpful for our listeners. And if you have a few takeaways, continue to save for retirement. If you're in retirement, be conscious of the way that you spend. Maybe look at some semi-retirement or job options, but enjoy your time in retirement as well. So with that said, thank you for listening.
Until next week, folks, may you grow in wisdom and knowledge. Thank you for listening.
We have a few more things to let you know about before we go. Podcast reviews really help us to serve more people and get this information into the hands of the people who need it. Please leave us a review. Even if it's not 5 stars, we welcome the feedback.
And we invite you to let us know what topics you would like to hear more about, or what would benefit the people in your life who you're closest to. We have more resources online. Those resources are designed to help you share this great information easily with people in your life. To access those resources, please visit tricordatvisors.com.
Often we hear from clients that they wish they had talked to us sooner. If that's you, we'd be thrilled to see how financial planning can benefit your life. Email us at contact@tricordatvisors.com or simply click on the link in the show notes.
This show was produced by Graham Gardner at Model FA. Find out more about how to create a podcast for your financial planning business by visiting modelfa.com. We love creating content that's useful, resourceful, and maybe even a little entertaining. We want to make this mega universe of financial topics and advice applicable and helpful to your life.
Remember, at Tricord Advisors, we are your future's best ally.